Welcome to our webinar, The Great 401k Ripoff, How Wall Street, Big Business, and the Federal Government Stole Our Retirement. Hi everybody, my name is Stephen Kelly, and I am the creator of the More Now, More Later Planning Process and Academy, of which this program is a part. I've written several books on retirement planning, have a radio program called the Free Money Radio Hour, which you can access on fmgpod.com, and I am the founder and president of Coach Capital Management and Safety First Financial Planners, where we have one driving principle that shapes everything we do, and that is, until you remove risk, it's not planning, it's hoping. What to expect? We are going to demonstrate why we believe the 401k is wrong for today's retirees. We are going to talk about the most common myths and deceptions designed to keep you invested. We will discuss concrete alternatives to the old risk more to make more model. How many times have you been told that if you want to have more growth or more income, all you need to do is take on more risk? We think that's an outdated and dangerous model. I reject it outright and believe there are better, less expensive, and certainly more effective ways of doing things. I'm going to provide an irresistible offer you won't be able to refuse, and we are going to give away a special bonus gift for everyone who stays to the end. So, the Great 401k Ripoff. Wow, that's a provocative title. Why do we say that? In his groundbreaking study for the Harvard Business Review, Nobel laureate Robert Merton wrote, America's shift away from defined benefit pension plans toward defined contribution retirement plans transferred the investment risk from the company to the employee. What was once an add-on to traditional retirement planning, defined contribution plans, epitomized by the ubiquitous 401k, have now become the main vehicle for private retirement savings. But although the move to defined contribution plans arguably reduces the liability of business, it has, if anything, increased the likelihood of a major crisis down the line as the baby boomers retire. So exactly how did this 401k thing break our retirement system? First, it took the investment risk out of the hands of the seasoned and professional institutional investors employed by corporate pensions and put it into the hands of millions of ordinary people who had little, if any, investing knowledge. Secondly, it took longevity risk out of the risk pool, where it was managed by lifetime guarantees, and it put it squarely on the shoulders of those same individual retirees, where it magnifies other issues such as market risk, inflation, and healthcare costs. Further, it transferred longevity from a powerful force to be monetized and leveraged into a critical problem to be managed without providing the tools to manage it. It transformed a relatively small tax burden from our income earning years into a massive tax burden during our retirement years that puts undue and, in some cases, unendurable stress on our fixed incomes and can raise Social Security taxes and Medicare premiums, as well as put added and unnecessary strain on fixed income retirees. In addition, it created a huge pool of untaxed money that has become one of Congress's favorite tax targets, ensuring it will only get worse as Congress continues to pile up trillions in debt. Congressional leadership has already indicated its intent to target, quote, entitlements, end quote, in order to cover the huge deficit the latest, quote, tax reform, end quote, will cause. Question, do you believe that Social Security and Medicare, for which you have paid your entire working life, are entitlements other than the fact that you've paid for them so you're entitled to them? Congress does, and it's coming after you. The 401k subjected retirement accounts to fees that can drain a retirement of up to 90% of potential accumulation. It moved income out of safe and guaranteed pension plans into risk-based markets that can and have crashed and wiped out trillions in retirement assets, twice in just the last decade alone. The added risk involved, especially market and longevity risks, limit the amount of income one can take from a 401k to well under 4%. About 1/3 to 1/2 the income pensions provided on a guaranteed basis. The dismal decade of the 2000s eliminated more than 10 years in growth potential for most savers. This is huge because if you believe the statistics, we should be getting about 7 to 7.5% a year in growth, and according to the rule of 72, that means just 10 years of no growth reduced the average retirement plan by half. If you want to know how much you lost, just look at what you have, and that's what that dismal decade cost you. For example, if you have $250,000 in your account, that lost decade cost you $250,000. Think of it this way. Had you not had to deal with that decade, you might have twice as much income for the rest of your life, and that's on top of the reduction in income you take simply by being in the market. Beyond the 401k, federal recovery efforts have clobbered interest rates such that traditional retirement savings vehicles such as CDs, T-bills, money market accounts are now useless for retirees, causing much more risk to be taken with savings. How did this happen? How did we go from having one of the most effective retirement systems in the world to one of the worst? In his best-selling Who Stole the American Dream, Pulitzer Prize winner Hedrick Smith introduced us to the surprising and sordid beginnings of the 401k.
And they got the 401k program. It got put into the tax code by Barbara Conable, an upstate New York Republican, who was doing a favor for Kodak and Xerox, the two big companies that had home offices in his district, and they wanted to give a new retirement benefit, profit-sharing benefit to their top executives. And so they went to Conable and said, if we do this, can you write a tax shelter into the tax code for them so they can get the retirement, they don't have to pay taxes on it, it can grow until they retire. And then when they draw the money out, they'll pay taxes on it. You recognize that because that's the way the 401k program operates. But it was done for them. It was never done as a national retirement program. It didn't become a national retirement program until the Reagan administration said, okay, we'll let it be for every worker. And then it really took another decade until the 1980s when the mutual fund industry wanted to get its hands on managing all the money that was in the retirement programs of many of these companies. And they said, wow, if we can get our hands on that money, there's big money there. And they sold it to everybody. Power to the people. Do-it-yourself retirement. Why let your boss do it? You can do it better.
This chart shows what's happened. Back in 1979, 84% of people who participated in employer retirement plans had a defined benefit pension. Only 16% had only a defined contribution plan. By 2011, that had reversed itself, and 69% only had a defined contribution plan, while only about 31% had any kind of defined benefits plan. So everyone understands a defined benefits plan actually states your benefits. It defines how much your pension will be, how long you will get it, if there will be anything going to your heirs, inflation adjustments, etc. It tells you what you get regardless of how long you live or how well investments do. The risk is entirely on the plan. A defined contribution plan just tells you how much you put in. There is no telling at all what comes out. The market could crash and you could outlive your money. We don't and can't know. The risk is 100% on the shoulders of the individual investors. Worse, there are benefits to group plans such as pooling longevity risk that cease to be available with the demise of pensions. The ongoing and aggressive shift in risk from the employer to the employee is now part of the fabric of our retirement system. The age of risk and speculation is born. As pointed out by Smith, it all began during this 20-year period from 1980 to 2000, where we saw 1,270% growth in the market. We'd never seen anything like this before the Revenue Act of 1978 and the advent of the 401k. I like to call this the boomer boom, as it was our retirement investments that spurred the growth. In 1980, we had 20 million shareholders, and by 2000, there were 100 million shareholders in the U.S. stock market. Back in 1980, the total market cap of the U.S. stock market was $1.5 trillion. During that 20-year boom period, $5.2 trillion flowed into the market from our self-directed IRAs and 401ks. Think of that. It took over a century to build $1.5 trillion in market wealth, and only 20 years to nearly quintuple it. In 1945, there were only 68 funds with $450 million invested. By 1980, there were 564 mutual funds with almost $135 billion invested in the United States. However, by 2000, that number had grown to over 8,100 mutual funds with almost $7 trillion invested. That's over 5,000 times, which is 500,000% in just 20 years. According to the New York Stock Exchange, in 1980 there was a volume milestone of 100 million shares traded in a single day. By year 2000, with the availability of trillions of new retirement dollars, the proliferation of mutual funds, and the high-velocity computer trading that was now available, we had hit 2.1 billion shares in a single day. My recollection of the single-day record is 5.8 billion shares. By now it might actually be higher than that. Who really cares? The issue is the same. How do investors like you and I compete in this? How do we ever gain the edge we need to succeed? A lot of people seem to think this could all happen again. In fact, lots of people think it is happening already, and Wall Street does nothing to disabuse them. Could this dynamic repeat itself? Let's look at some of our market conditions. For example, what impact, other than huge losses, did the dismal decade, as we like to call the decade from 2000 to 2010, have on the markets? According to Grant Thornton, we had 40% fewer companies by 2007 than we had just 10 years before, and we have been losing ground ever since. Today, it is estimated we have fewer than 4,000 publicly traded companies in the U.S. exchanges. In addition, baby boomers are now retiring at the rate of 10,000 per day, and that began in 2013, which means that they are now drawing out their required minimum distributions. Markets that enjoyed huge growth in the last decades of the 20th century are now undergoing the harshest forced decapitalization in history. So could this repeat itself? First, you have to shrink this graph way down to where you can hardly see it, so it will be in scale. And then you have to stack this up against it until the Dow grows to over 330,000. How likely do you really think that is, with investors leaving the market, companies leaving the market, and an uncertain economy? Recently, after the Dow broke through 25,000, there was a lot of wild hyperbole about how this was the greatest milestone in bull market in history from 2008 to 2016. This is exactly how they mislead us, by playing on our emotions and diverting us from the truth. Sometimes there is a difference between being factual and being truthful. Yes, if you chart the bull from the depths of the Great Recession, we have an average rate of return of around 12.33%, which is close to the boomer boom period. Those are the facts. However, the truth is, if you chart it from just the year before, it is reduced by half to 6.5%, which is below average for the market. So unless you were able to lock in your gains at the end of 2007, and then from the middle of 2008 on, which is exactly what we did using our formulas and indexing strategies, you did not enjoy the full impact of the boom. In fact, assuming you just rode the whole thing out like most advisors recommend, from the end of year 1999 to now, your return was only 4.4%. There really isn't much of a correlation between the 25,000 mark and what actually happened at the end of the 20th century. It's all a matter of scale. In order to repeat the magnitude of the boomer boom, it would have to repeat itself 11.2 times. Do you really believe that will happen again in your lifetime? Here's why all of this is important. The average rate of return from 1920 to the present was 7.69%, including dividends and inflation. $1,000 invested in the Dow in 1920 would be worth $1.2 million today. If we agree the boomer boom was an anomaly, should we rely on that period of 17.88% growth when calculating potential growth from the market? Or should we treat it as an outlier and remove it from our calculations? I guess you should start by determining what your planning goal is. Is it to come up with a plan that you can count on to get you through the next 30 years of retirement? Or is it to create a plan that will make you feel good by inflating the numbers? As a person who always uses very conservative assumptions when crafting a plan so as to provide retirement plans my clients can count on, I believe the prudent course is to eliminate it. So the average rate of return between 1920 and 1980 was 6.67%, including dividends and inflation, and from 2000 to now was 5.48%. If you average that out over the last century, you get 6.42% rather than 7.69% if you leave it in. growth of $1,000 between 1920 and now would have been $391,000, assuming dividends and inflation. That's a bit less than 1/3 the growth attained by leaving that period of time in. So keeping the boomer boom in the equation inflates returns by about 3 times. Is that what you want? Or do you want more accurate predictions of what could really happen in the future? So if we don't believe that the market will repeat the huge gains of the boomer boom, what do we think may happen? Perhaps the greatest investor of all time is Warren Buffett. Buffett's favorite metric is the ratio of the total market cap, or TMC, to the gross domestic product, or the GDP. This is also known as the Buffett indicator. Since this metric has first been tracked in the 1950s, the total market cap, as represented by the blue line, has crossed above the total GDP, the green line, only 3 times. Those were the periods just before the 2001 and 2008 crashes, and now. As you can see from this slide, it is currently far above where it ever reached in either of those situations. What has kept the market so high? Since 2009, in an effort to help markets recover from the Great Recession, the federal banks have pumped over $15 trillion of interest-free money into the economy. This has caused interest rates to plummet, and now the world has $233 trillion in debt. Interest rates are still at historic lows, and as much as $11 trillion of debt trades at such high prices, yields are negative, meaning investors in these instruments who hold to maturity are guaranteed to lose money. This has completely wiped out the safe haven status bonds have traditionally enjoyed. Negative yield bonds are purchased as purely speculative instruments, betting on deflation and making them wholly unsuitable as a retirement strategy, thus fueling the runaway equity markets. As interest rates rise, bond prices will surely crash, and equities, losing their risk dividend, will soon follow. Not too long ago, I was in Las Vegas on a business trip. I am not much of a gambler, but I do enjoy watching, and besides, it allows me a place to enjoy a good cigar, one of my favorite pastimes. As I was walking around, I noticed different styles of play. One type of player just seemed to be all in all the time. Those tended not to last long, or if they did, more often than not, they went back to the well over and over again. Another type of player would routinely take their winnings off the table, pacing themselves, and making sure they didn't sink into a huge abyss of losses. Some of these people won quite a bit. We, too, have won quite a bit in the market over the past few years. Much more, perhaps, than we probably had a right to expect. Maybe it's time to take some of our money off the table and secure it for our future. But if we do that, how much do we move and where do we put it? What are the options? To facilitate this process, we have adopted a planning model we call ABC Planning. ABC Planning focuses on the role of your money first and allows you to easily make decisions about how much to put where. It works like this. We have identified 3 types of money: the A, or yellow money for cash, the B, or green money for ongoing lifetime income, and the C, or red money for speculation and growth. Before deciding how much to put where, let's look at the characteristics of each. What is the yellow money for? It's for liquidity and safety. What kind of assets provide that? Market-based? What if they are down when you need your money? You would then have to sell into a decline and take a potential loss. We don't want that, so we use safe money accounts like insured bank accounts, CDs, money market accounts, and liquid annuities. The latter can actually decide the desired liquidity with potential earnings of up to 6%, so they are worth a look. How about the green money? That's for income. What do you want your income to look like? Well, most people want it to be predictable, dependable, regular, abundant, and durable, meaning it should last your lifetime without question. So let me ask you, which of those adjectives describes the market? What about bonds? Well, yields right now are very low. In fact, over $12 trillion of the world's sovereign debt is trading at negative yields, meaning people are having to pay for the privilege of lending these countries money. As interest rates do rise, there is a very good chance bond prices will decline, so that doesn't sound so good either. So we need a new asset class, which is why we use the new breed of hybrid annuities that provide safe growth along with contractually guaranteed income that you cannot outlive without having to give up control or access to one's money. That sounds a lot better. And red money provides opportunity for growth. Since that's the primary purpose, we can use risk-based assets such as real estate, commodities, securities, and all manner of various investments. What do you give up? With yellow money, it's rate of return and growth. Do we care? Maybe, but not enough not to do it. We have plenty of opportunity for growth in the red, and without enough yellow, we could jeopardize both the red and the green, so we choose to fund this. With green money, what do we give up? Liquidity. But we're covered on liquidity with the yellow, and the green provides ongoing liquidity through regular, predictable, and dependable income. Besides, we've been saving this money all our lives for retirement income, and liquidity is not a component of that objective. It may be the most important money you have since it's designed to go as long as you live. Think about that. The longer you live, the more money you have. You never have to scrimp and save because you are afraid you will outlive your money. With red, we give up safety, but we have that covered with both yellow and green, so you only put as much in the red as you can tolerate risking. How much should go in each? In yellow, keep enough for foreseeable emergencies and other predictable non-budgeted expenses over the next 6 to 12 months, and then add half again to 2 times that amount for the unforeseeable expenses. This is not the same as the 6 months of salary we've always read about, as by definition we aren't going to have a salary to lose and have to replace in retirement. In red money, you should not have more than you can tolerate losing. A good place to start is with the rule of 100. Subtract your age from 100, and the answer is the maximum to risk. Dial it back from there if that amount makes you feel uncomfortable. So a 60-year-old might begin the discussion at 40% and then adjust from there. For green money, you want enough to support your lifestyle. People are often reluctant to spend their cash in investments, so we try to have enough ongoing cash flow to provide extra that can be used for discretionary spending, usually 60 to 70% of holdings. A key benefit of ABC planning is it takes the guesswork out of your planning process. Once you have completed this exercise, you should have a relatively easy time determining how much of your money to put where. We also find when people are comfortable in a plan like this, they have a much easier time making more rational decisions about their investing choices. In keeping with the various types of money, there are also 4 styles or phases of investing that must be addressed. These are speculation, accumulation, decumulation, and preservation. If you listen to Wall Street, all these phases are interchangeable and there is no difference in the way they should be managed. This is a critical error that is at the root of most retirement plan failures. Speculation is when you have your money at risk and you keep it there. You have no idea how much you have or how much you can spend going forward because your wealth can fluctuate on a daily basis. It never actually locks in until you sell it, and once sold, what then? Accumulation, on the other hand, does lock in your balance and adds the gain to it each year, and then locks that in as well. Your money continues to grow and never contracts unless you withdraw it. This chart shows the difference between the two. The red line is the S&P 500 from 2006 to 2016, and it reflects a basic truth about risk management. Losses hurt more than gains help. Compare it to the green line, which is a strategy we use that provides half the upside in the market with none of the downside. It's a great way to lock in gains and continue to participate in market upside while protecting yourself from future downside. Many of our clients have avoided catastrophe by opting out of market losses permanently. Imagine how good it would have felt to just say no to the Great Recession. These contracts are guaranteed never to lose any money, and they can lower or even eliminate fees altogether. How much better would you sleep at night knowing you never had to worry about market losses again? The flip side of accumulation is decumulation, and it must also be done with an eye towards preservation if a retirement plan is going to work. Decumulation is the retirement income phase. It is a critical time that can last decades, and mistakes are costly. Most advisors would tell you to just move more of your money into bonds and less in equities, like target date funds, and that's it. This is a critical error that is at the root of many retirement plan failures, as bonds are not the safe money instrument people think they are. The reason is volatility in the market kills income. It can happen very fast and take years to recover, and often people never do. People's income requirements tend to be consistent, but market returns are not. Down markets at the wrong time can mean selling off shares at depressed values, requiring more to be sold than was budgeted for. Here's an example of what that might look like. This account has $500,000 in it and is earning a 4.4% rate of return. The client wants to get a 7% income payout plus an annual 3% inflation adjustment from it over the next 10 years and have some money left over. Will that work? It should. So we start with $500,000, get a 28% year one, take out $35,000. At the end of the year, we have $605,000 and we are off to the races. By the end of 10 years, we have received all of our income and still have over $300,000. Everything worked just as planned. But wait, what if the first year we suffered a 38% loss instead of a 28% gain? This doesn't impact the rate of return. It's still 4.4% according to the commutative law of multiplication, which states 2 times 5 is the same as 5 times 2. So would it make a difference? Let's find out. Oh my, that can't be good. 1 year in and we are already down over 50%. What happens next? See, there's a huge difference based solely on the sequence, not the rate of return. Hence what's known as the 4% rule, which, like so much of our, quote, retirement system, end quote, is a made-up device designed to support a broken system and preserve the status quo. Back in 1995, a financial planner by the name of William Bengen was looking for a solution to the question of how much a retiree can take from their retirement accounts and not run out of money over a potential 30-year retirement lifespan. Looking in his financial texts, he found there was no answer. Remember, these things had just started 10 years before. After doing a lot of backtesting using historical data and faulty assumptions about the future, he assumed markets would continue to grow at their 90s pace well into the 2000s. Bengen determined one could spend 4% a year, adding a 3% inflation adjustment each year. That's 3% of the 4%, and expect about a 90% confidence level they would not run out of money for 30 years. That lasted for about 6 years until the tech bubble burst and was completely buried after 2008 when T. Rowe Price conducted a study that concluded the chances of not running out of money had declined to 6% from 90%. To repeat, the chances of failure were now shown to be 94%. Just 10 years or so into a 30-year window. Looking at this chart, that 6% number is actually 6% chance of success. So one should ask, was it ever really 90% in the first place? T. Rowe Price didn't just end the study there, though. They spent a lot of time trying to come up with a solution. Several things stuck out. First, continuing on the original path led to near certain doom. So they did what Wall Street always does in these circumstances. They looked for the best way for you and me to cut back on our retirement so they could preserve the status quo. You might notice in all of these scenarios that cutting fees is never considered. The first scenario was simply reduce spending by 25% for 3 years after each bear market bottom. That led to a 43% chance of success. Next was eliminate the inflation bump for 3 years after each bear market bottom, and that led to a 26% chance of success. Finally, they looked at moving everything into bonds, which led to a 0% chance of success. The winner? The 25% reduction for 3 years. This really boils down to cutting back on what you withdraw. Many of us think it's impossible to cut our spending, but the truth is we live in such affluence we can cut if we absolutely have to, wrote Christine Fallon, senior partner for T. Rowe Price, who has probably never had to cut back on anything in her life. Certainly not the fees she charges clients for advice that blew up in less than a decade. Morningstar also did a study on withdrawal rates. They determined, we find a retiree who wants a 90% probability of achieving a retirement income goal with a 30-year time horizon and a 40% equity portfolio would only have an initial withdrawal rate of 2.8%. So the 4% rule just became the 2.8% rule. The question becomes, how low can we go? Again, keep on speculating. Just spend less. Reduce your lifestyle. We have plenty. Just tighten your belt. To which I say, really? That's your answer? Tighten my belt? I don't want to tighten my belt. You tighten your belt. There's another question that to me sticks out like a sore thumb, and that's what happened to those 7% to 12% estimated rates of return that everybody likes to talk about all the time. If we can expect a 7% rate of return in the market, why can't we expect 7% income from our investments? As we have learned, it's because the key factor is sequence of return, not rates of return. Now you know why we say until you remove risk, it's not planning, it's hoping. Let me ask you a question. If you purchase a car and later find out it doesn't work as advertised, does the auto manufacturer just say drive less? Just stay home? Tighten your belt? Now consider this. If you were in retirement and were told by your planner suddenly to tighten your belt, how would that make you feel? What do you think you would say to your planner? If you were later to find out there was a different way that didn't ever require belt tightening and would guarantee you enough to live for the rest of your life, how would that make you feel? I think the biggest deception of all is one Wall Street won't talk about, and is that the defined contribution model didn't just transfer the savings investment risk to the middle class, it transferred 100% of the longevity risk as well. And this is key to making retirement plans work. Longevity should be positioned as a risk class to be monetized rather than just a major problem that exacerbates everything else in retirement, like inflation, taxes, healthcare costs, and market risk. We are living much longer now. If you're 65, you have a nearly 50% chance of living to your mid-80s and a greater than 25% chance of living into your mid-90s. If you're married, doubled that. It's not exact, but it's close. In other words, you would have a nearly 100% chance one of you would live into their 80s and a nearly 50% chance one of you would make it past 90. So that's 25 to 30 years of retirement that you may need to address. According to Nobel laureate Robert C. Merton, the shift in focus away from retirement income to return on investment that has come with the introduction of saver-managed defined contribution plans means investment decisions are now focused on the value of funds, the returns on investment they deliver, and how volatile those returns are. Yet the primary concern of the saver remains what it always has been. Will I have sufficient income in retirement to live comfortably? Clearly, the risk and returns variables that now drive investment decisions are not being measured in units that correspond to savers' goals and their likelihood of meeting them. Thus, it cannot be said that savers' funds are being well managed. But the thing is, we have no idea how long we need to plan for. I wrote a book on this called Tell Me When You're Going to Die, and I'll show you how well you can afford to live. How do you plan for an unknown period of time? If we knew when we were going to die, it would be easy, right? It's called math. We could use a calculator to figure it out. But when we are talking about retirement, we're talking about a complete unknown. That doesn't call for a calculator. That calls for a crystal ball. We already know Wall Street's solution, just spend less. But is that really all there is? Think, if you will, for a moment about fire insurance. What's the risk class fire insurance uses? Is it like retirement where they put your money in the stock market and hope you accumulate enough to rebuild your home if and when it burns down? And if they don't have enough money, do they just say spend less, build half a house, or do without walls? No, they leverage a risk class that matches the job. What's the job? To rebuild houses that burn down. What's the risk class? House fires. How do you monetize house fires? Easy. You sell fire insurance. You start by figuring out the likelihood a home will burn down and the replacement cost, and then you put that house in a risk pool with thousands of other houses. Each homeowner pays a premium based on the probability and cost of replacing their own home. The homes that burn down are rebuilt by the homes that don't, and everyone can sleep at night knowing they won't be homeless. What if we did that for retirement planning? What if we took the probability of living to different ages, charged a premium for covering that lifespan, and put it into a risk pool with thousands of other lives and guaranteed everyone would have enough money for the rest of their lives? What would that look like? A pension. With a pension, everyone is assumed to live to life expectancy, and the calculation of how much to pay them is the amount of money in their pension fund divided by the number of years until life expectancy. So in this scenario, the amount in the plan is $300,000 and life expectancy is 13 years. So the retirement income is $23,000 a year. That's 7.7%. That's a payout that matches the estimated rate of return. Why can't Wall Street do that? Because how long you live has nothing to do with how much you can sell a share of stock for. The two don't correlate at all. But how long you live does correlate to life expectancy, so the two match up perfectly. It's like socks and gloves. Both do essentially the same thing, keeping our appendages warm. But it's really hard to get a shoe on over a glove and be comfortable. But I don't own a pension, so buy one. People buy them all the time. In fact, thousands of personal pensions are sold every day. It is estimated over $50 billion in personal pensions will be purchased this year alone. Insurance companies sell them. They are called annuities. But I don't believe in annuities. No, that's not true. You just don't know enough about them. And so you are believing what you hear from those same people that misrepresent the fees, the risk, and the impact of keeping your money locked up with them to speculate with for all your life, just so they can keep on feeding at that $320 billion trough. There's an old saying, to a hammer everything looks like a nail. Now you can certainly use a hammer to drive a screw, but it completely defeats the purpose of the screw, and it does a real number on the board. Now if you are a hammer salesman and the potential customer was having trouble driving their screws with a hammer, what would you recommend? Would you recommend a bigger hammer, or would you recommend something you don't sell? And as a customer, would you be better off going to the store that sold only hammers, or a store that specialized in making sure people left with the correct tools for the job? Lately, there has been a radio and TV advertisement where a prominent financial guru comes on the air and says, "We don't sell annuities. We will never sell annuities." To which I always respond, "But what if you need an annuity?" It might also be of interest to know this man charges some of the highest fees of any wealth manager in the country and requires at least $500,000 to even talk to one of his advisors. Further, he claims he can present you with a 15-minute retirement plan, which I find to be ludicrous. However, he is worth billions of dollars, so if you want to be a cog in his machine, I recommend you give his firm a call. There are a number of myths, or untruths, if you will, that are foisted upon us to keep us quiet and invested so as not to upend the Wall Street gravy train. The first is a combination of two myths, really. A, that fees are reasonable, they are only around 1% a year, and B, a fee-based model is what's best for the client. The truth is 401k administrative fees are usually between 0.5% and 1%. However, fund fees like expense ratios and selling costs are not included in the administrative fees. According to the Wall Street Journal, in selecting mutual funds, most investors know how to check the expense ratio, i.e. the standard measure of how costly a fund is to own. U.S. stock funds pay an average of 1.31% to the portfolio manager and for other operating expenses. The article goes on to quote Morningstar, Inc., "There are other costs not reported in the expense ratio related to the buying and selling of securities in the portfolio, and those expenses can make a fund 2 or 3 times as costly as advertised."
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get. The money managers always want more, and that's natural enough in most businesses, but it's not right for this business.
Bogle gave me an example. Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. Bogle says you've lost almost 2/3 of what you would have had.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us. Do you really want to invest in a system where you put up 100% of the capital, you the mutual fund shareholder, you take 100% of the risk, and you get 30% of the return?
Let's test that here. If you had put $100,000 in the Dow in 1976 and left it alone until the present, it would have grown at an average return of about 7.28%, and you will see it grow to over $3 million. However, if you deduct the 2% fee Bogle was referring to, we see that our balance goes down by 2/3 to a bit under $1.1 million. In other words, fees decimate your retirement account. Remember, too, that what I am describing is Wall Street's favorite and what they claim is best for you, a fee-based system. Turns out we were misled again. Looking at this slide of Federal Reserve data, you can see there is currently $14.2 trillion in self-managed 401ks and IRAs. At just 2.3% times $14 trillion, which is pretty much undisputed as the low end of fees imposed, Wall Street's cut is $320 billion a year in and year out, typically just for sitting on and speculating with our money. Another, quote, Hall of Fame, end quote, piece of financial advice is also one of the most common. Don't spend your qualified money because you will have to pay taxes on it. Use your other money instead. Have you ever heard this? I've heard it more times than I can remember for years, and it turns out to be not bad advice after all. Let's look. This is the top marginal tax rates from 1913 to 2009, and you can see this is where we are now. We are currently at the low end of the tax brackets historically. This is back in 1980 when the 401k was first introduced for the benefit of the Xerox and Kodak executives. As you can see, the top marginal rate was 70%, so it made lots of sense back then to want to defer taxes until later. You almost couldn't lose. But does it really work when we're all at a low tax bracket? Right now, when the effective tax rate for most people is around 15 to 18%, does it make sense in this environment? Here's a tool we use to evaluate the impact of tax deferral on retirement accounts. This person's working income started at $95,000 a year and grew at about 3% per year over 20 years to $176,000. I used a relatively high earner because I wanted a fair test. A low earner and a low tax bracket would not have proven the point as effectively. Employee contributions are 10%, and the employer match is 3% for a total match of $179,000. Total taxes, if the employee contributions are not deducted, are $503,000. With the contribution deducted, taxes are $434,000 for a total savings of $69,000 or about $3,500 a year using the qualified plan. In retirement, total income in the qualified scenario where contributions were deducted and all income is now taxable begins at $73,000, including $40,000 from their retirement accounts and $33,000 from Social Security. From that, we subtract the standard deduction of $20,400, and we come up with the taxable income of about $53,000. As you can see, taxes on this income start at twice the tax savings during the working years. For the non-qualified scenario, the only taxable income is the Social Security income, less the standard deduction, and that doesn't kick in till age 79. The net on this is tax deferral in the accumulation phase provides a relatively small tax savings at today's effective tax rates. However, that is eclipsed by the severe tax liability it shifts into retirement when most people are on a fixed income and the taxes are generally a larger proportion of their income than it was in their working years. However, when you introduce the company match, it can offset the hit in the aggregate, which it does here. Still, one should ask if it's worth disrupting one's retirement by taking on an onerous tax burden in retirement and giving up control of and access to one's money while working for a quite insignificant benefit of about 6% of total tax burden. So my rather obvious question is this: if tax deferral doesn't really help, and the industry recognizes this, as it shows it does with this admonition of not spending your qualified money, Why do they still push us into these qualified accounts? You would think if they knew something didn't work, they would stop advocating it, right? Not so much, I guess. One simple technique I often recommend people try is our proprietary Roth Advantage program. The Roth Advantage is a simple two-step program that allows you to convert your qualified funds, for example, your IRAs and 401ks, etc., into a Roth IRA account over a 10-year period and recapture up to 100% of the conversion taxes such a transfer creates. This can dramatically change the picture of your retirement and is a great way to get out of the 401k death spiral we have just covered. These contracts have minimal fees, are guaranteed for life, and reduce your risk as well as your taxes and fees dramatically. Any money left over after you pass away will go to your heirs, again 65% tax-free. The net result is guaranteed income for life that is 2 to 3 times more than the market typically provides, along with lower taxes and fees, no market risk, more money to your heirs, and dramatically more money in your pocket. In this illustration, we see how converting about $700,000 over a 10-year period puts an additional $1.75 million in the client's pocket. So if you were your advisor, how much of your money would you want to manage? All of it, right? And how long would you want to manage it for? Forever, right? Have you ever tried to move your money away from your advisor? And if you have, what response did you get? Have you ever tried to get your advisor just to move your money out of the market during a downturn so you wouldn't get clobbered? What kind of response did that get? Were you told doing so would risk losing out on the best days and you would ruin your retirement and should just ride it out? I remember the first time I heard this, it didn't ring true for me then, and it doesn't now. It turns out it's pretty easy to test. Shall we? This chart shows the performance of the S&P 500 from 1980 to 2015. We have identified the 30 best and 30 worst days during that period and charted returns based on capturing and avoiding combinations of those days. This line, second from the bottom, represents staying invested during that entire period. If you start with $100,000 in 1980 and keep it fully invested until 2015, you get about $2 million. That's almost 9%, not bad at all. But what are these other lines? What is this one on the bottom? That's missing the best 30 days, so as you can see, performance goes down by more than half. So they do have a point, these buy-in holders. However, there are 2 other lines on the chart that they rarely, if ever, refer to. I think I like this red line. Look, it did almost 5 times better than the S&P. What is that? It turns out that one, the best strategy by far, is avoiding the 30 worst days. So, avoiding bad days is a much more powerful strategy, it turns out, than making sure you are in for the best days. Does that speak to active or passive management? Now, what's this other line, this one here? That points to $3 million. That, it turns out, is missing all of the worst and all of the best days. So as it happens, if you don't have any of them, you get a whole 1.15% more, and over a 35-year period, that meant another $1 million. So it turns out the risk of missing the best days may not be so bad after all. Here's an illustration of a point often overlooked by the buy and hold crowd, that losses always hurt more than gains help. Here's a very simple but very powerful illustration of that. Assume you have $1,000 in stock that then loses 50%. So what do you have left? You have $500. Now, the market gains 50%. What do you have now? The $1,000 you just had before you lost 50%? No. You have $750 because 50% of 500 is only 250. See, it doesn't simply matter what the market does. It also matters what you have invested at any given time. Once you lose half, you only have half invested and must gain twice as much to get even. So even though 50% minus 50% is a 0% rate of return, the real return is a 25% loss. Here's another way to look at it. Check these two accounts out. The first account is very volatile and has a 60% gain year 1 and a 40% loss year 2. That averages out to a 10% annual rate of return. The second has a 10% gain year 1 and a 5% loss year 2, for an average rate of return of 2.5%, 1/4 of the other accounts. So, based on just those numbers, you would probably pick the 10% over the 2.5%, right? Okay, let's check it out and see what it does to the money. Start with 1,000 and multiply it by 1.6%, reflecting the 60% gain in year 1, and by 0.6, reflecting the 40% loss of year 2. What are the results? $960. But wait, didn't we figure on a 10% annual rate of return? Yes, but remember, losses hurt more than gains help. 40% of $1,600 is $640. That's more than you made in year 1 and a lot to lose in year 2. Now, looking at the second scenario, we find that 1,000 times 1.1 times 0.95 equals 1045, proving yet again losses hurt more than gains help. So the number one lesson about speculation is losses hurt more than gains help. The number two lesson is speculation always involves unexpected and unnecessary losses. This slide shows the top 5 American Funds Group mutual funds by market cap. These include the American Balance Fund, the Capital Income Builder Fund, the American Funds Euro-Pacific Growth Fund, the Growth Fund of America, and the American Funds Income Fund of America. Now, one might think, looking at the names of these funds, that they would be negatively or anti-correlated. But when you look at how they performed over time, one might assume they are highly correlated. Well, first, let's stipulate that they are negatively correlated, because in fact they are. Just looking at the Growth Fund of America versus the Income Fund of America, one would see they're holding entirely different assets. So then why the extreme correlation of behavior? I think it's because some kind of outside forces are in play. It used to be investors would pick assets based on things like price-to-earnings ratio, capitalization, and profit margin. Not so much anymore. Remember the new economy of the dot-com bubble? Remember how people kept saying profitability wasn't important anymore? That still persists today to some degree. Today we don't typically invest in stocks, we invest in funds. Instead of companies, we look at asset classes and sectors. Maybe our focus should be more on those outside forces than just the funds or other securities we purchase. This slide depicts 3 of the 8 signals we use to monitor what we believe the market's behavior will be. Notice it's a 15-year period. These techniques only really work in the longer term. I'm only going to spend enough time on these to convey the most general high-level insight to how they work. If you want to know more, each can be found on the internet. The first of these signals is known as the relative strength. This signal is useful in comparing different asset classes and market segments. When the relative strength is below 30, the bottom red line, the market is thought to be undersold, and it produces a buy signal. Conversely, when the relative strength is over 70, the top line, the market or asset is thought to be oversold and might represent an opportunity to divest. The second signal, known as the Golden Cross Death Cross moving averages, compare the 200-day moving average to the 50-day moving average. When the 50-day moving average crosses over the 200-day moving average, that's known as the Golden Cross and signals a buying opportunity. When it goes the other way, that death cross signals an opportunity to sell. At the bottom, we have the moving average convergence divergence, also known as the MACD. This is very similar to the moving averages above. However, it uses an exponential moving average, EMA, which weighs more recent time periods over those more distant in the past, as opposed to the simple moving average above, or SMA, which looks at all days as the same. It's important to note that all signals must agree before we take action, and remember this is fewer than half of the signals we use when managing your money. Something else I'd like to point out about this style of active investment. We are not making daily trades. If you look at this 15-year chart, you will see over that entire period of time only 2 or 3 adjustments were made. So what happens when these signals are used? Do they provide a better rate of return? I'll let you decide. This is the period between 2000 and 2016. The very bottom line is the S&P 500. All of the other lines are proprietary formulas from our investing partner, Formula Folios. As you can see, actively managing the funds, which allowed us to miss most of the crash of 2007, significantly improved performance. At the beginning of this workshop, I promised you a gift if you stayed until the end. Well, here it finally is. We are giving you a formula that you can test and employ on your own without having to rely on a broker or any other representatives, including us. You can do this online by yourself using 5 asset classes you can capture with low-cost index funds. These asset classes are U.S. stocks, international stocks, real estate, commodities, and bonds. This is what you are going to do. Check only on the first or second trading day of each month. Only hold funds when they have positive returns over the past 5 months and 10 months. In other words, check each one 10 months ago and 5 months ago and today. If both comparisons reflect a gain, add them up and pick only the top 3. If only 2 funds pass muster, invest 33% in each and keep the balance in cash. This keeps you invested only in the strongest asset classes and avoids the weakest asset classes while staying diversified. What's the result? We backtested this formula for the past 17 years and found we have more than twice the money at the end than we would have in the S&P 500. So it's easy and effective, and it's yours free. Just enter your information at the end of this presentation and we will happily send you a set of instructions. In addition, we have another special gift, but this one is more involved and will require you to contact us so we can set it up for you. This gift is called Wealth Guard and is added protection for your portfolio. Think of it this way. The formulas we use to manage your accounts are like driving a car. You turn, accelerate, and stop, usually without incident. But occasionally bad things happen, so your car is equipped with seatbelts and airbags. Think of Wealth Guard as an airbag. We hope it never deploys, but we don't want to be without it either. Essentially, Wealth Guard follows your investments as they increase and then sets a floor when they begin to increase. The Wealth Guard value rises each time your accounts go up in value, so while markets are good, your Wealth Guard value steps up after each new high. Should markets decline and your Wealth Guard value be reached, you now have a definitive reason for when to change your investment allocations to something more conservative, or leave the market altogether. This process helps guard your investment, potentially locking in years of market gains, thereby helping you to solve one of the deadliest drawbacks of market investing, which we discussed before. You don't own it until you sell it. The whole point of this presentation has been to show you the results of good planning. So what are some of the problems with more traditional types of planning? First, they often are 80 or 90 pages of stuff you don't understand. They're complicated and expensive, focusing on inputs, not on outcome. Oftentimes they are cookie cutter, and they don't really address your needs, wants, and desires. We believe a plan should be about the people, not about the money. It should focus on outcome, not inputs. It should be a plan you understand completely and without reservation. You should be part of the planning process. And finally, it should make it easier for you to sleep at night. What to do next? Click on the button below to get started. You will be asked to provide some information that will help us gauge where you are in your planning process and how likely you are to succeed. If you desire, we may be able to review your material and make some recommendations. Simply request a call and we will call you back at the requested time. This will qualify you for Wealth Guard. All of this is free with no obligation. We are also making a special offer to anyone who would like to engage our planning services. Our normal price is $800 for a plan, but if you do it as part of this process, we will cut that in half to $400. This will give you a complete retirement income plan you can use any way you want. In addition, this plan will be delivered in an online format that you will be able to access whenever you like and tweak it as you need to. One thing we know for certain is the only constant is change. You will find your ability to adjust your plan as life plays out will be a very valuable benefit of being our client. We offer a zero-risk guarantee. After all, removing risk is what we specialize in. If at any point you are unsatisfied with the process, just let us know and we will refund your money, no questions asked. So that's it, easy peasy. Click the button below and get started. One more thing. Please fill in and return the workshop evaluation that has been emailed to you. And thanks for participating in our webinar.